Welcome and thank you for joining us today. This is the Erudite Series on the future of Africa, featuring financial flows. Your moderator today is Pamla Gopaul, AUDA-NEPAD, Program Office Knowledge Dissemination. Please keep your microphones and cameras turned off until we reach the question and answer portion for today's event. The question and answer session will be conducted using both the chat function and the raise hand function on your Zoom application. To access the chat function, kindly scroll to the bottom of your Zoom application, click on the chat button, and the chat box will appear. Should you wish to raise your hand, kindly click on the reactions button to access the raise hand function. During the question and answer session, the moderator will acknowledge you and you will have to unmute your own microphone and turn your own camera on to make your comment or ask your question. Please note, we will evaluate this event using an online poll. The evaluation is completely anonymous and it helps us to present better events in future. Kindly do take a moment to complete it. It'll be launched following the presentations portion for today's event. As we wait for our final participants to connect their audio, we kindly remind you to please keep your microphones muted and your cameras turned off until we reach the Q&A portion for today. Please also note that since this is a public event being broadcast live on Facebook, Chatham House rule does not apply. This is the Erudite Series on the future of Africa, featuring financial flows. Pamla, you have the floor.
A very good morning and welcome from sunny and warm South Africa today. A special welcome for those participating for the first time. This is our final series before the think tank conference to be held in Addis Ababa from the 3rd to the 4th of October on the theme Africa Futures. And the focus will be on Africa's development prospects in terms of Agenda 2063. As mentioned, my name is Pamela Gopaul. I am the lead coordinator of the Policy Bridge Tank at the African Union Development Agency. This seminar is co-hosted by AUDA-NEPAD and the Institute of Security Studies. Today, private financial flows, which is known as FDI, and remittances often have overtaken aid and their impact and significance. Remittances are Africa's largest source of external financial flows, but their effort on economic growth is limited. Diaspora bonds and other emerging products have the potential to advance progress. To this effect, AUDA-NEPAD sees the significance in engaging actively and leveraging the knowledge content generated by think tanks to identify and address continental and regional challenges through evidence-based policy and knowledge services. The program aims to help translate research, output, and connect knowledge and decision-making platforms to build and intellect Africa's driven science research and policy space. To remain relevant in this space and harness world-class knowledge and research, problem-solving policy analysis and foresight capacity on Agenda 2063, we have partnered with the African Futures and Innovations Program of the Institute of Security Studies, who are the specialists in providing meaningful contributions through Africa's broader economic transformation to support national and regional development plans and processes. As I've said before, a foreign direct investment has the most significant impact on growth and GDP per capita. It also is considerable impact on reducing poverty in lowering middle and upper income groups. FDI is also important for its contribution to knowledge and skills, as well as technology transfer opportunities. Aid is the single largest impact on poverty amongst low-income group countries, and Africa is marginalized as an investment destination and gets only 5% of global foreign direct investment flows. The African Futures and Innovations Financial Future Scenario will be presented today by an expert lead in this topic on financial flows as a critical pathway offering the potential to drive economic development and improve the livelihoods of Africa's people. This can be brought about by transforming the productive structure of African economies and unlock more rapid advancements. So FDI is higher levels of investment, strengthening innovation to strengthen, to increase productivity and product design and development, which act as key inputs and as an avenue to build trade and drive further export growth. The African Futures Innovation Program brings the foresight analysis, which integrates the International Futures Modeling Platform and serves to analyze complex and long-term dynamics of change in human, social, and natural systems. Today, our aim is to share resources and knowledge content to improve the way we contemplate and plan for global future. With this, I would like to now introduce you to Dr. Kwazi Uboba. Is currently senior researcher at the African Futures and Innovations Program in Pretoria. He recently served as a lead author on ISS studies on the long-term development prospects of the DR Congo and the Horn of Africa, of Nigeria, as well as Malawi. Dr. Kosi has published on various issues relating to foreign direct investment in Africa and is interested in issues related to development economics, macroeconomics, international trade and finance, and economic modeling. He has his PhD in economics. Dr. Kosi, over to you, and thank you for joining us today.
Thank you very much, Pamela. Thank you for your introduction. As you said, today our discussion will be on financial flow into Africa. Why financial flow is important to Africa? We know Africa has made progress in terms of development in recent years, but unfortunately, Africa still accounts for the largest share of poor people globally. 60% of poor people are in Africa. And also the gap between GDP per capita and of Africa and the rest of the world keep on growing. So Africa needs external resources to fund its development project to generate sustained growth to eradicate the high level of poverty in Africa. So this morning, my presentation, we have two main objectives. The first one is to take you through the recent trend in financial flow to Africa. And secondly, show you how more financial flow to Africa can affect the continent development prospect. So my presentation will be done through our website. Okay. I think I cannot share, Pamela. I can share screen. Yeah, okay.
Okay, Richard, you can share now. Can you share now?
Okay.
I think we need to give you sharing rights.
Yes.
Richard and team, would you be able to assist us?
Richard, if you can assist me to share my screen.
TJ, can you provide sharing rights to Kwasi, please?
I'm sharing now.
Yes,
okay.
Yes, you are. All systems go. Thank you.
Okay. So as I said, my presentation will be done through our website. So one of my colleagues will paste the link to this website in the chat function, and you can access our website. Through this website, you can have access to our analysis and forecast on the development process of all African countries. If you go here, we have the list of all African countries. You can select any country you want and see our analysis and forecast on that country's development prospect to 2043. Where 2043 marks the end of the third 10-year implementation of the Agenda 2063, African Union Agenda 2063. The first 10-year implementation ended in 2023. The second one will end in 2033, and the third one, 2043. So this marks the end of our forecast. So you have forecast for all African countries to 2043, regions, ECOWAS, North Africa, Sub-Saharan Africa, regional economic communities, and income groups. We can also have our thematic reports, demographic, agriculture, health, education, manufacturing, the full implementation of the African Continental Free Trade Agreement, leapfrogging, financial flow, which will be the subject of our discussion today, large infrastructure, and governance. We have had already seminars or conference seminar or other team like demographic and financial flow is our last seminar. And we have also Africa in the world, how development happening in the rest of the world affect Africa development prospect. And we have our blog, interesting blog that keep you informed about issues that affect Africa's development. Then if you go to About, you can get more detailed information on our forecasting tool. This is our forecasting tool. For those who are interested, we use the long-term forecasting tool developed by the University of Denver in the United States. It's a very interesting model that has been used for policy analysis in Africa and also widely used in academic literature. For those who are interested in knowing more about our forecasting tool, my colleagues also will paste the link to the description to the model in our chat function. So today, our discussion will be on financial flow to Africa. As I said, Africa needs more financial flow to complement its domestic revenue shortfall to fund its development project. As we know, Africa, in terms of tax to GDP, Africa has 16%. Tax to GDP ratio is 16% in Africa, the lowest among other developing regions. So what are the recent trends in financial flow to Africa? If we look at this chart, we focus on the main, the key financial flow to Africa. Here, this graph shows the trend in foreign direct investment, aid in blue color, foreign direct investment in orange, and remittances in green line. If you get from 2000 to 2021, and the vertical axis is the US dollar, current US dollar. So if you look at the trend, as I say, remittances is in green line. If you see here, you can see that since 2010, remittances has become the leading source of external financial flow to Africa, as Pamla mentioned in her introduction. So we can see this is the shock from the COVID-19. We see the shock from the COVID-19 here, but since then, financial remittance flow to Africa has recovered. And this is aid, we still see the shock. And here also we see foreign direct investment, and this is a shock from the COVID-19, but since then, foreign direct investment flow to Africa has also recovered from the shock. And now, foreign direct investment flow to Africa is the second largest source of external financial flow. As we can see, and US is the leading source of aid to Africa. But we can, how does Africa compare to other developing regions when it comes to this financial flow? Let's see. Here, let's look at aid, Africa compared to South Asia and South America. This is a trend, historical data, and forecast from 1961 to 2043. So the green line is aid flow to Africa. The orange one is for South America, and the blue is South Asia. We can clearly see that Africa receives more aid, in absolute value, more aid than other development regions. And going forward, the current path, maybe in the business as usual scenario, aid flow to Africa also is forecast to improve, and aid go mainly to low-income countries in Africa. But when we look at in percentage of GDP, this is absolute value. Let's look at percentage of GDP. In percentage of GDP, we see that aid is becoming less important as share of GDP. After a peak of about 6.6% in 1990s, aid as a share of Africa GDP has been declining, and in the business as usual scenario or in the current power forecast show that by 2043, aid as share of Africa's GDP will be about 1.3%, which is very low, and it will be much lower for other developing regions. So let's see remittances, how Africa compared to other developing regions. Africa, remittance flow to Africa is the green line, South America, which is orange, and South Asia is the blue line. Here, if you remember, Africa received more aid than other developing regions, but South Asia received more remittances than other developing regions than Africa. And on the current path, Africa and other developing regions are forecast to receive more remittances. And many factors can explain this positive forecast because of demographic pressure and increasing gap between developing regions and advanced countries, and also climate change that will push many people to migrate to find better economic opportunities. So we are expecting more remittances flow to developing region going forward. So let's look at foreign direct investment, how Africa compared to other developing regions. Here, we can see South America, orange line, Africa, green line, and South Asia, blue line. Over the period 1990-2043, we see foreign direct investment flow. We can clearly see that South Asia received more foreign direct, South America, excuse me, received more foreign direct investment than Africa and South Asia. So Africa received more aid than other developing regions. South Asia received more remittances than other developing regions, and South America received more foreign direct investment than other developing regions. Africa has been marginalized in the current financial globalization. Despite the high return on investment in Africa, the continent has about 5% of global foreign direct investment. On the current path, we expect a more foreign direct investment flow to Africa, as we can see the green line, and somewhere by 2042, Africa is forecast to overcome South America. And many factors also can help explain this positive forecast. For example, the full implementation of the African Continental Free Trade Agreement will drag many foreign investment into Africa. And currently also with the growing geopolitical tension, and have many producers, local producers are trying to diversify their source or their production location. And Africa can be maybe a new way or a new source of global supply chains. And at the same time, Africa has more resources that needed for green transition, such as electric vehicles and also, and all this will attract foreign direct investment to Africa. And there are two main types of foreign direct investment. We have brownfield investment and greenfield investment. We talk about greenfield investment when an investor, for example, creates or establish a new firm in a foreign country. And a brownfield investment is when an investor buy an existing company in a foreign country. So greenfield investment is very important enough for Africa because it increases production capacity, capital accumulation, technology transfer, and economic growth. And China is leading in terms of greenfield investment to Africa. And as you can see on the graph, here, if you look at the graph, the green one is the average 2006, 2010. The orange one is the average 2011, 2015. And the latest period is the average on 2016, 2020 period, which is the blue one. When you look at this, you see clearly that China, over the period 2016, 2020, China accounted for about 20% of the total greenfield FDI to Africa, which is far from USA, 6.6%, France, 5.6%, and UK 4.6%. So clearly, China is leading in providing Africa with greenfield foreign direct investment, which, as I say, is very important to improve capacity production on the continent. And another good news about Africa, foreign direct investment flow to Africa is also it is diversifying into other sectors. As we can see, initially, the large share of foreign direct investment go to the mining sector, but recently it has been diversifying into other sectors. As you can see, the number of projects by sector in Africa on this graph. In 2020, for example, business services accounted for 74 projects, telecom 68 projects, advanced manufacturing 55 projects, automotive, and here when you look at mineral and metals, 13 projects. We see clearly that FDI flow to Africa is diversifying to other sectors, although the large share still go to the mining sector. And this is very promising in terms of capital accumulation, technology transfer, and economic growth because of the strong linkage between the manufacturing sector and the other sectors of the economy. So let's see the other type of capital flow this year. I would say illicit financial flow. Getting data on illicit financial flow is very challenging. And for those, there are many definitions for illicit financial flow, but simply we can define illicit financial flow as the movement of capital or money, illegal movement of capital or money from one country to another. And many studies have shown that in Africa, it's mainly caused by multinational companies and some government officials that steal from public purse. So when you look at this trend, this graph here is on average, top 10 African emitters of illicit financial flow, the average over the period 1980-2018. We see clearly that South Africa is leading, followed by Democratic Republic of Congo, Ethiopia, and other countries, as we can see clear here. So study has shown that annually Africa is different illicit financial flow that lead Africa is about 90 billion. Every year, Africa loses about 90 billion in terms of illicit financial flow, which is more than the annual financing gap in health, and also even twice the annual financing gap in education in Africa. Clearly, illicit financial flow is undermining development because it's taking away resources that can be used to fund our development. So after this brief presentation in the recent trend in key financial flow to Africa, we ask ourselves, what if Africa is able to attract more external financial resources above what is forecast in the business as usual scenario? So to do that, we designed our scenarios. This diagram shows the structure of our scenario. So what we did, based on what the model can do and what the model cannot do, as the model, I briefly introduced the model, the International Future Forecasting Platform. So what we did, we increased remittance in flow to Africa. They say, what if Africa received more remittances? What if Africa received more foreign aid? And what if Africa received more foreign direct investment, more portfolio investment? And what if Africa is able to significantly reduce illicit financial flow? As I said, it is very difficult to get data on illicit financial flow. So in the model, we use outward for FDI, the foreign direct investment that leave Africa, Africa's foreign direct investments abroad as a proxy for illicit financial flow in our modeling strategy. And the key assumption here that if all these things go together, improvement in all this type of capital flow, Africa, we're expecting Africa to see increased capital accumulation, increased technology and knowledge transfer, increased household consumption in aggregate demand, especially from remittances, as is mainly good to consumption. And the ultimate goal is economic growth. It finally affects economic growth. So when we simulate the impact of this scenario, this is what we got as results. So let's look at the impact on GDP per capita. The graphs show increase in GDP per capita in financial flow scenario relative to the current path in 2043, meaning the difference in GDP per capita in the financial flow between and the GDP per capita in the current path forecast. So when you look at positive value means that the country gain. And when you look at, we see positive value for all African countries. Despite the fact that some countries gain more than others, depending on the domestic factors, domestic policies, and also the size of the population. And when all this is aggregated, the GDP per capita of Africa improved by about $215 compared to the current path forecast, which is huge because the size of African population is forecast to be more than 2 billion by 2043. So improvement of $215 is huge. And let's look at the impact on poverty. Here also, as I said, the percentage point reduction in poverty, $1.90 in 2043, current path versus financial flow scenario. So here, negative value means that the country experienced a reduction in its poverty rate, and we see negative values for all African countries. And with countries such as Malawi, Liberia, and Sierra Leone getting more reduction in terms of percentage point in poverty reduction. When we look at the right-hand side of the graph, we see that the impact of the scenario has marginal effect on poverty reduction. This is because these countries have already eliminated extreme poverty at $1.90. It's mainly North African countries, Morocco, Egypt, Tunisia, and Algeria. But when all these things are aggregated, it means that the scenario take out of poverty 50 million people in Africa compared to the current path forecast in 2043. And we can also show the graph here, the absolute number of poor people that we get out of poverty due to more financial flow to Africa. When you look at here, this is the current path, the blue color. By 2043, Africa, the number of poor people will be about 400 million. And in the financial flow scenario, it will decline to about 363 million. And the top 10 countries that get more in terms of number of people out of poverty is Nigeria, DR Congo, Malawi, and Mozambique, and also other. And Nigeria and DRC are the countries with the highest number of poor people in Africa. So far, what I have presented, I have shown the impact of the total foreign direct financial flow to Africa. But there is no reason to believe that all types of financial flow to Africa have the same impact. So we push the investigation further to see the impact of each type of financial flow on Africa's GDP per capita and poverty. So here we can see the impact of individual capital flow on Africa's GDP per capita, variation relative to the current path. So when you look at this chart, it clearly appears that foreign direct investment has the most significant impact on economic growth in Africa. When you look at the GDP per capita here, it's about 142 compared to the current path, followed by portfolio investment, international portfolio flow, aid, and remittances has little impact. And because remittance mainly go to consumption in Africa, as we can see, but this is so for all income group, lower middle income group and upper middle income group, the result is the same. So let's look at the impact on poverty. Each type of capital flow on poverty. Here we can see this is for Africa. Also clearly, foreign direct investment has the most significant impact on poverty reduction in Africa. It's followed by aid. Remittances also contribute to poverty reduction because, as I said, it's mainly go for consumption, support many poor households in Africa, and portfolio investment. But when you look at, for example, low-income Africa, you see that aid has the most significant impact on poverty reduction, closely followed by foreign direct investment. This is because aid mainly go to low-income countries in Africa, and we have some countries in Africa where aid accounts for even 50% of the national budget. So aid is very important for these countries to provide a key social service to the population, pushing the vulnerable households by providing safety net programs. So aid is very important for low-income countries for poverty reduction. So with all this evidence, we provided some policy recommendation. We have provided key detailed policy recommendation in the report, but for the sake of the time, I will summarize some of them here. So what we suggest that African government must creatively use aid to stimulate growth and poverty reduction. Studies have shown that in countries in the presence of good governance, strong institutions, aid can contribute to growth and poverty reduction. And there are some countries in Africa, such as Rwanda, where aid has been effective. And we suggest that donors should make good governance a prerequisite for aid and refrain from pushing agendas not in the interest of African countries. And remittances provide a stable income for millions for poor households in Africa, and must be encouraged and facilitated through better regulation and lower costs. Sub-Saharan Africa, the most expensive place for money transfer is Sub-Saharan Africa. So we need a lower cost with stimulate more remittance to Africa to help many poor households on the continent. Diaspora savings also should be mobilized to fund development projects through diaspora bond. The business climate in African countries needs to be improved by government to encourage people to invest the money they receive from relatives overseas. And foreign direct investment, as I said, improve capital accumulation, knowledge transfer, and boost economic growth as the funding show. So African governments should work harder to attract investment from the rest of the world by doing what? Improving institutional quality, political stability, and infrastructure, providing a well-educated labor force. This is called domestic condition. What we say, Africa needs to improve its domestic condition to attract more foreign direct investment. African countries should also strategically channel FDI into sectors aligned with their developmental goals. This is what South Korea and other South Asian countries did to accelerate their development. African countries must improve border collaboration, data collection, and monitoring system to reduce illicit financial flow from the continent. And finally, African countries should also guard against the potential risks associated with a large flow of foreign cash, such as real exchange rate appreciation, which could weaken the competitiveness of the export sectors. It is known in the literature as Dutch disease. So I think I have talked too much. I will stop here to allow the discussion to flow. Thank you, Pamela.
Great, thank you so much, Kwasi. I really, really enjoyed listening to that. Especially, you know, when you did the model on the foreign direct investment and what the situation is versus South Korea and Africa today, South America and Africa today. I think what is interesting is often we talk about South American challenges are the same as African challenges, but we see a different trajectory. But most importantly, that trajectory turns, you know, positive in the long run, simply because African countries, you know, have the potential of moving from aid recipients to aid donors, and especially with the introduction of the African Continental Free Trade and its implementation, I think intra-African aid will also be a strong possibility. And just to mention that at the African Union Development Agency, we have two flagship programs called the traffic light system, you know, as you see the red, green and yellow, depending on which stage, facilitation in the areas of the border control. And we also have the one-stop border post to facilitate the efficiency of flows of goods at borders, also to curb the illicit financial flow. So I just wanted to mention that. But thank you so much. We'll move on to the next, and then we want to give time to open up to our audience who have joined us today. We want to thank you again. For those who have just joined, welcome. Our next our discussant for today, I would like to warmly welcome Mr. Amit Jan, who is the director of the Nanyang Technology University, the Center of African Studies at the Nanyang Business School in Singapore. Welcome to you, Amit. Amit is the frontier market specialist whose work spans across business, intelligence, capacity building, and consultancy. The Center for African Studies is a practice-orientated think tank that conducts research, fosters network and builds capacity for doing business in Africa. It is located at the Nanyang Business School in Singapore and is the only research center in Southeast Asia that looks at Africa from a trade, from a business and an investment perspective. So Amit, thank you so much for joining us, and over to you. Thank you.
Thank you so much, Pamla. I hope everyone can hear me well. What I really liked about the paper, Kwasi, and kudos to you and Jackie for putting this absolutely wonderful piece of research together. I mean, for those of who are on the call, I wish more of those people interested in the growth of Africa could be on it. If there's one paper you should read and get up to date about the state of financial flows and other matters is what you have laid out. I would say those three important sources of financial flows that you have stated very clearly, aid, remittance, and FDI, are going to be absolutely vital. What I wanted to find out is that you have laid a lot of emphasis on FDI, much more so than perhaps portfolio investments. Is that because South Africa really is the only place that has adequate depth of a capital market? I can see a lot of that change with the ALEP, which is the Africa Exchange Linkage Project that's coming up soon, which is to unify regional stock markets together. That will essentially be a part of the African Continental Free Trade Area experiment, but with one shot, it will, multiply the size of the capital markets for any foreign investors, and that to me is going to be could be a game changer if done right. African markets have returned on average 8.2% since 2002, much better on the MSCI Frontier Markets Africa Index than as compared to Asia. So it would be ideal for a lot of African governments to pay special emphasis to make sure that the LEP comes into play. The other question that I had in mind was to ask you, if at all, how effective has the AFDB $6 million project has been on the African Financial Integrity and Accountability Project, which is aimed at stemming the illicit flow. If you could throw some light there. And a curious aspect of the study that came to me was that even though we see a significant increase in FDI going up, your study still predicts that in absolute numbers, aid will also increase by 2043 to $350 billion. And correct me if I read that wrong. But, as foreign direct investments improve, remittance improves, then the role of ODA should actually go down, both in percentage as well as absolute. I don't think there is much appetite now, even in the West, for aid to continue. It's neither among the recipients nor among the donors. So if you could put some spotlight on that, please.
Thank you, thank you, Amit. Thank you for that very important and interesting point, Kwasi. I'll allow you the floor to address some of these questions that have come out from your presentation.
Thank you, Amit, for your comments. Well, portfolio investment, we did not highlight much about for portfolio investment. Yes, you're right, because only a handful of African countries receive a portfolio investment. And as we said, South Africa and other few North African countries, because the local financial market is poorly developed. And only in South Africa, when we talk about local financial development, it's only South Africa and some North African countries such as Egypt, or we can talk about a local financial development. For example, where South Africa, an indicator that is used to measure the level of development of financial development is private sector credit, bank credit to private sector. When we look at South Africa is about 100% of GDP. But for the rest of Sub-Saharan African countries, it's barely reach 20%. You take my country like Cote d'Ivoire, bank credit to private sector is 15% of GDP. So and without a better development of local financial market, it's very difficult to attract portfolio investment, which is very important determinant of portfolio investment. The aid issue, as we focus and improve in aid, I think you are right, with growing foreign direct investment and other type of capital flow, we should be, maybe aid should be going down, but also it depends on the determinant of growth in the of aid in the model, which is GDP growth in the provided country that provide aid. So if GDP growth in the country that provide aid going down, increase, it definitely also push up aid in the model that we use for the forecast. And also now, as you say, there's also push for advanced countries that provide aid to use 0.7% of their gross national income as aid. So we expect that if these countries are able to achieve this target, and going forward, Africa will be receiving more aid. So those are some response I can provide to your comments.
Thank you so much, Kwasi. You know, on remittance, it still costs, as you noted earlier, it costs a lot to remit money into Sub-Saharan Africa, much more so than any other region. But this could become a thing of the past if the Pan-Africa Payments and Settlement System, that it's called PAPS, it comes into place. And I think the AFCFTA Secretariat is really pushing that very quickly. Some dry runs have already been done, and they are predicting that it would save at least $5 billion a year in transfer and settlement charges. If the technology is right, if they get this right, then central banks are expected to sign by end of next year. That is very close. And once all the central banks sign up across AU, then they will quickly be followed by commercial banks. So it will simplify cross-border transactions, reduce dependency on hard currency, because a lot of that transactions will be settled in local currencies. And so this would completely change the game for a lot of businesses that face, at least small and medium enterprises that face enormous costs on doing cross-border transactions in Africa. It's killing the enterprise. So yeah, give me your thought on that. Yeah,
remittance, it's true that the cost is very high now. As I mentioned, 8% of the amount transferred to Sub-Saharan Africa. And the SDG target is by 2030 is 3%. We are still far to the SDG target. And the market, remittance market is notoriously monopolistic. To break it down, it's like a cartel-like structure, which prevent the price to go down. So you have only few service providers and many customers. So that it prevents the price to go down. That's why it's still high. But as you said, digital payment will bring this cost down going forward. Because remittance is very important, and Africa can leverage to fund its development. For example, Nigeria in 2017 raised 300 million via a diaspora bond. India, for example, is a country that has been using diaspora bond to fund its development. So far, India has raised about 10 billion in terms of diaspora bond. So we need to facilitate remittance flow to Africa. And one thing I want to mention that when you look at cross-border migration in Africa, you see that 2/3 happen on the continent. One African country moving from another African countries. And you see countries like South Africa, Cote d'Ivoire, Equatorial Guinea, they are net remittance senders. Instead of receiving a remittance, they are net remittance senders. My country, Cote d'Ivoire, account has 26% of its population coming from outside. So Cote d'Ivoire, for example, is a net remittance sender. But sending money from one African country to another country is very expensive. It costs about $70 to send $200 from Uganda to Tanzania, which is too much. So it does not encourage people to send money. So this is what we should be working on to reduce remittance flow to Africa. This is what I wanted to say.
No,
Thank
true,
you,
Kwasi, you're so right. These are some of those barriers that are in place, but I think that we are now at the cusp of change. And once it starts to happen, one or two of those initiatives that we have been discussing gets into play, I think the scenario that you have painted, even in the financial flows scenario, the actual outcome would be much better. I mean, clearly Asia shows that that's possible, right? I noticed you mentioned diaspora bonds. This is something worth paying. Spending a little bit more time on dissecting. Several reasons why I think African governments should consider this, right? One is it's a low-cost instrument to raise capital for long-term investment. Two, you have a very large diaspora of Africans, spread all around the world. 20 million Africans outside Africa, and then I think the figure that you had is about 150 million of people of African descent outside Africa, or something on those lines. So that's a pool of potential capital waiting to be tapped. They can be paid back in local currency. A diaspora is typically more willing to take more risk than, let's say, a foreign investor sitting in London or New York. That's because a lot of that tugs on the desire of immigrants to give back. Now, whether it's to their community or to their country. But, if you take the example of Indians in Singapore on a per capita income basis, they would fall within the top 1% of the top 10% income bracket. But many are, a large proportion of them are also low-wage blue-collar workers where I'm sitting. And they have to save to send back to their families. Same thing in Africa. The annual interest offered by local banks in OECD countries is very little, no more than 3% at best these days, right? Maybe it's become better after US interest rates have gone up, but right now that's the case. But with, let's say, the example of non-resident Indian bonds, they can get well over 7%, and that is not all that the government of India allows NRIs to do to repatriate coupons right upon maturity. It's all tax-free. If that can be replicated for Africa, I'm sure a lot of new sources of capital will open up. Those are the kind of incentives that they might need to think of when introducing diaspora bonds. It has to be done carefully, though. And I have some thoughts on that, which I'll be happy to share shortly. But give me your thoughts on the importance of diaspora bonds, and perhaps feel free to put some new look at it in a new way, perhaps, if you can.
Yes, thank you, Amit. Yeah, diaspora bond. Africa is looking for a new source of financing because of the high cost of borrowing on the continent. Many African countries now cannot have access to the national financial market, and we pay interest rates about 8 times higher than Germany, or 4 times higher than United States. So we need other sources of funding, clearly domestic revenue mobilization, but at the same time, as you said, diaspora bond, which is very important. Africa can get this money at maybe lower interest rate than what is prevailing on the international market. And this foreigners, those who are living in Africa, Africans that are living in other countries, they are able to contribute. Some of them through a patriotism sentiment, they are able to contribute to buy this bond to help their country make progress. And also, it provides additional resources to African countries to fund their development. But at the same time, more remittance will help Africa to improve its debt sustainability, because remittance is a source of exchange foreign reserve. If you get more remittances, it increases your foreign reserve. And the level of foreign reserve of a country is an indication of that country's ability to pay its debt, because most of our debt is in foreign currency. So you need foreign reserve. So actually more remittances will increase reserve and increase debt sustainability, and also give confidence to investors to reduce interest rates on our debt. So African countries, African policymakers should consider exploring the benefits of remittances. Thank you, Amit. You are muted.
You're mute, you're mute.
You are muted.
Okay, no, you're absolutely right. I couldn't agree with you more. But when it comes to issuing diaspora bonds, a couple of things that need to be considered. Number one, consider what the fund is going to be used for. So if you look at the example of India and Israel, they've been used either in times of financial crisis or to raise funds for infrastructure, right? So this is something that Ethiopia has done very successfully for the Grand Renaissance Dam, project of national prestige.
Yeah.
It could also be used for education. The bottom line really is that the diaspora community is willing to rally around a cause, but it's not enough. They must know that their money that they're investing is going to be invested for the purpose it is being raised. And so trust is the single most important operating principle if African governments want to think of floating a diaspora bonds. So what that means is take a really hard look at the operational capacity of the state to manage that fund and create that trust. It requires credible governance framework, a watertight investment guarantee that cannot be changed arbitrarily, no matter by any future government. And yes, it still needs attractive rate of return, even if it may be less than what you might have to offer to other foreign investors. It is still a proposition. No diaspora will put in money if they're going to lose it. So issuing country needs a decent credit rating for that. And I think if you think of high risk appetite doesn't mean no risk perception. So if your annual rate of inflation is hitting, say, 25% and the interest on your coupon is 9%, it makes no sense to issue a bond. So issue a bond only when your fiscal position allows you to do so. So I'm very positive. Just last week, African Union has decided to create a new credit rating agency. A lot of buzz and talk around it. But it turns out that it's going to be private sector led, perhaps an alternative to the big three that dominate credit rating right now. And so this is welcome news. So for far too long, Western credit rating agencies have unfairly rated African economies. And so, I mean, the figures that I kind of read was that Africa loses $75 billion just on the basis of unfair credit rating, ratings given. If that can become more realistic assessment, then that'll bring down the cost of borrowing.
For me, we can't.
Hello,
sorry, Kwasi. Yes, we can hear you now.
Or can you hear me?
Yes, we can hear you, Kwasi. Please go ahead.
Okay, yeah. Governance is, I totally agree with you. I mean, in terms of, sometimes when they ask me, what is the key challenge to Africa development, I say governance. The poor governance is one of the key factors prevented Africa from going forward in terms of development. So when during my presentation, I mentioned that about 30% of illicit financial flow is from government officials that steal from public purse. So if you know that this money is not going to be used to fund infrastructure, education, or health, nobody is going to invest. As I said, it's some of these Africans in advanced countries do it for patriotism sentiment. But if they know that this money is going to go back to Western banks, they are not going to subscribe to this bond. And as you say, macroeconomic stability is very, very important, because when you look at the interest rate, the real interest rate is the most important, which is the difference between nominal interest rate and the inflation rate. So in a country where inflation is very, very high, and you provide a very low nominal interest rate, nobody will come, because really you are losing in terms of real interest rate. So macroeconomic stability is very, very important to attract investors to the continent. So I totally agree with you, Amit.
Thank you. We are in violent agreement on this. I really like the 4 recommendations on curbing illicit flows in your report. Closing the tax loopholes, a public registry of beneficial ownership, improving the capacity of tax authorities, and international cooperation. I mean, all those 4 need to come together. But I'd like to add one that I would say also need reforms, which are these bilateral tax treaties. Now, these bilateral tax treaties sometimes make it possible for MNCs to, multinational corporations, to evade taxes and engage in profit shifting. I'm encouraged to see the United Kingdom finally is moving to compel some of its overseas territories to make corporate ownership public. That's great news. India renegotiated the double tax treaty agreement with Mauritius not so long ago to make sure that beneficial ownership is not allowed to have the same tax benefits. The BEPS, base erosion and profit shifting initiative that you have alluded to in the report is certainly something welcome. But give me your insight into what you think. How fast do you think that these things will come into play, and what you're witnessing right now?
Yeah, thank you. As you mentioned, bilateral tax treaties. I think this is an important point you mentioned. That's also facilitating this illicit financial flow. Let me give you an example. There is this agreement, this colonial agreement between French-speaking countries and France in Africa. The agreement states that, for example, France multinational companies operating in this African country do not pay their tax in that country. They pay their tax in France. And in return, for example, a multinational company from Burkina Faso also will not pay tax. Operating in France will not pay tax. But the problem is that any multinational company from Burkina Faso is operating in even any European country. So you see, this is a strategy to take money out of Africa, illegal way. They don't pay tax, and Burkina Faso is losing about 50 billion in terms of in France CFA, their local currency, 50 billion in terms of revenue every year because of this colonial agreement. So I completely agree with you that those unbalanced bilateral tax treaties also facilitate illicit financial flow and from Africa. And we, as you say, we need collaboration. Frankly speaking, no single country is able to deal with illicit financial flow. We need global cooperation and the reform of this global tax architecture to allow more inclusive and development on the globe.
Yeah, back in the 1970s and 80s, there was this whole move towards financial liberalization, which was recommended by Bretton Woods institutions to a lot of African governments. And what that really did was to reduce their ability to capture some of the outflows, monitor and regulate it properly. Taking inspiration from Mauritius, other governments also decided that they will lower their taxes and so on, hoping that will encourage a lot of foreign investments. But that really hasn't. The evidence is thin on that. I hope there is more studies done on how to get that right. It's not clear that we are in that phase yet.
Yes, true. I agree with you. Yeah.
Great. I could hear you both the whole day. That was really, really interesting. What I got from it is the importance of building consensus. Trust is the most also valuable component to this. I think also tangible results, and not just, all the talks must turn into tangible results. Government spend, even exploring the sovereign wealth possibilities of funding. Also, I'm hearing the, understanding of engaging beyond governments, where, development banks play a fundamental role now. And also in the public sector, we cannot just depend on public sector. We need that mix of financing. And I think most importantly, also the tailored and context manner in which we look at it, because regarding interest versus inflation, the tax avoidance element, different countries tell a different scenario. So I think this is just very interesting conversation. I'm going to open the floor, but just to also allude to the African Development Bank role as an observer in the global forum. I think they are, promoting African tax transparency very strongly. And over the past year, I think we had a 26% increase on African countries requesting for information for tax collection. So I think, we're continuing to move in the positive direction in that case. And I really want to take on more questions from the audience now to, leverage this interesting discussion. If the audience has any questions, both to Amit or Kwasi, please do not hesitate. Raise your hand or just switch on your mic, and feel free, please, to discuss and air your views or make your comment. It will be really interesting to hear what you have to say as well, and the value that you bring to this conversation. I'm not seeing any hands, but I don't see anything. We have a few more minutes left. I think if there's no comment from the floor, is there anything else, Amit, you would like to say in regards to this? I see a hand from Elizabeth Serenopoulos. Hello, Elizabeth. Thank you for joining. Please go ahead.
Hi there. This has been great. Thanks, Kwasi. Thanks, Amit. I think it's nice to see you again. So this is not an area where I have expertise, but I've just got a couple of questions. The one relates to aid, and I think you touched on it, Amit. I mean, in the context, and I don't know to what extent, Kwasi, you've factored it in the context of the war in Ukraine and the huge reconstruction efforts that will happen invariably at whenever the war ends or is frozen. I mean, how is that going to impact on aid? Because I would have thought that it actually, a lot of this is already being diverted. So I just wanted to know whether you factored that in, and what your views are on that in that regard. I also thought, looking, if I understood it correctly, your the forecast calculations in terms of reduction of in poverty, sort of, it is by 2043, right? And it was about 36 million. That is fairly small, I mean, in the greater scheme of things. And I don't know to what extent, you've also done other studies on other sectors, and how important in effect is the domestic environment, the ability to sort of increase local entrepreneurial activity, sort out the infrastructure, sort out the energy in the case of South Africa, well, in other cases as well, and also build up a tax base that might see that 36 impact on poverty overall. And I realize low-income countries are in a particular category and don't have the same opportunities. And then a question, and maybe this is a question for Amit, on taxation. I mean, really interesting, the comments obviously on tax evasion, on BEPS, etc. How do you see the agreement around the international taxation agreement around Pillar 1 and Pillar 2 in terms of its impact on Africa and the global minimum tax? I saw some studies a couple of years ago, and I stand to be corrected, where, and this was one of the reasons apparently that Kenya didn't want to sign up to it, that in fact, based on their tax, they were able to have, I don't know, I think it was 89 companies paying tax, and on the reduced one, it would be like in the low 20s or something like that. And so, you know, there was really no benefit from them. It was skewed to help the global north, in effect. Again, this is not an area that I'm following very closely. I pick up stompies, as we say in South Africa, and I'd be really keen to hear from you about those points. Thanks.
Thank you. Please go ahead, Kwasi, and then Amit. Okay. And I also saw a hand from Mavis, so we'll give her a chance to also ask her question. Please go ahead, Kwasi.
Okay. Then the comments on aid going to Ukraine, that is true. The Russia-Ukraine war has also drained aid from that should have gone to African countries to Ukraine. But I think with the geopolitical tension and advanced countries, US and other blocs trying to get African countries by their side, also we increase aid, because maybe they may use aid to try to lure African countries to get into their bloc, because we don't want to make choice, but maybe aid can be one of the instruments that Africa, this advanced country can use also to attract African countries to their side. So I think even with Russia-Ukraine war, aid will continue to flow to Africa, because for political reason, for strategic reason, not to aid to Africa is not really, the objective is not to help Africa to develop, but sometimes it's for strategic reason. Yeah. So I think aid will continue to come to Africa. And regarding the impact of the scenario on poverty, we measure it only in 2043, not the accumulated number of people out of poverty from 2023 to 2043. That is a lot, it's huge, but only 2043. When you compare the number of poor people in the scenario to the number of poor people in the business as usual scenario, the difference is 50 million, only 2043, not the accumulated number of poor people. So it's had a huge impact on poverty reduction in Africa if we are able to receive more external financial resources. Thank you.
Amit, over to you.
Thanks. Yeah, thanks, Kwasi. A good question, Liz. Look, like you, I haven't been paying that much of attention on track 1 and track 2 either. But our top line, let me put it this way. If you look at the pressure coming in on small countries that have become very successful, as facilitators of finance, they have been under pressure both from OECD as well as developing countries. On that front, OECD countries, largely lose a lot of their own taxes due to their multinationals taking profits out. So, and in countries of Africa, you have outflow going in through illicit means by criminal gangs, by high net worth individuals. So who wants to pay tax? Not you, not I. I mean, that's just the way it is. But I want to pick on 3 things. Firms want to save on tax, and so they will be enticed by tax. If there's any way to save taxes, they'll be enticed by it. So treating them as criminals is not going to help. Money seeks safety. Both high net worth individuals and firms want to protect their wealth. If that wealth has been created in an environment where tax laws can change any time and the state can come after your hard-earned or not so hard-earned wealth, then your instinct would be to move to a place where it can be protected. Criminals, would want to move their funds to places where it's less likely to be seized. So you can't blame them. That's the way it is. But as long as there are jurisdictions where the rich can preserve and grow their wealth, there will be illicit financial flows, which is why the global deal on minimum corporate tax of 15% is important. But not just Kenya, even Nigeria is refusing to join that tax deal because it says that it won't be able to tax its own medium-sized companies. if you look at the average corporate rate in Africa, it's 25% higher than APAC. Bringing it in line would be helpful. India recognized that 10 years ago, which is why the average corporate rate in India is coming down steadily over the years. And so when that kind of a new equilibrium happens, maybe we'll see better tax revenue collections by developing countries. There is an interesting initiative called the Tax Inspectors Without Borders initiative that's done by OECD and UNDP. It tries to help developing countries build a tax audit capacity. And so that also has helped, at least their figures show that it has helped governments raise up to $330 million. So, I may not have directly answered that question, but I think we'll have to see where that pulls and push, comes to an equilibrium, and we'll see where that goes.
Thank you. I think these are very, very important minds, trying to probe these, interesting questions that will resolve or try to help governments also think in this new dimension. Mavis, I might go to you. Hello, and thank you for joining. Please go ahead.
Thank you, Pamela, and thank you, Kusi and Amit, for the paper, and Amit for the interventions. I had a couple of questions for you. So, Kusi, first of all, when I look at your projections on FDI going up, you are projecting that we will continue to increase as a continent and at some point take over Latin America and actually exceed South Asia quite a bit. But I note that you have assumptions in there. So a couple of questions. Did your assumptions take into account the reduction or proposed reduction in FDI investments into carbon? So that's the first thing. Did it take into account, did you factor in the skills shortages and not skills shortages, but skills weaknesses on the continent and how that will enable us to really take advantage of evolution? And then the third one was when I looked at your slides on the growth in the different areas, I noticed that the fastest areas for diversification were actually in the service sectors. Do you envisage FDI increasing in, say, green manufacturing, green growth, any of that? Was any of that in your assumption? So that was my question to Kusi. And then my question to Amit was, you were talking a bit about remittances and the importance of remittance bond, with the caveats. I suppose my question to you is, how has the current context of debt challenges on the continent and the reduction in confidence in investing in government bonds, how will that affect the ambition to release more remittance bonds going forward? Thank you.
Jose, I think you can go, and then we give Amit an opportunity to respond to Mavis.
Okay. I don't know. Okay.
Yes, I can hear you.
Thank you, Mavis, for your comments and questions. In the model, we use total foreign direct investment flow to Africa. We don't have a foreign direct investment by sector in the model, but we have a total foreign direct investment on the continent. So it may include foreign direct investment to reduce, to accelerate green transition, and also other sectors. And as I said, there are many factors that can explain this positive forecast. We know with the full implementation of African continental free trade, which give access to a market of about 1 billion or 2 billion people by 2043, many investors will come closer to the market to supply the market. It's easier to come to South Africa, which has better infrastructure and supply goods to DRC and other countries. So we are anticipating more foreign direct investment from the full implementation of the illicit financial flow to Africa. At the same time, you know that Africa possesses much more this critical minerals that is needed for green transition, for energy transition, lithium, cobalt. You take a country like DRC, and many countries such as Ghana and other countries have banned, in Namibia, have banned export of this critical minerals. So inviting for investors to come to invest in Africa, to transform those minerals in Africa. And at the same time, with the growing geopolitical tension, many local producers or maybe producers on the international market are trying to find different area of production. And Africa can be a new area of global supply chains. And also you talk about skills. Yeah, skills also is another factor, important determinant of foreign direct investment, but it's not the only determinant of foreign direct investment. And skills is improving in Africa, even though it is slow. When you look at the trend, it's moving, it's improving. And there are other determinants of foreign direct investment, which are growth and the increasing size and the population in Africa. When you see the increasing middle class in Africa, which is forecast to reach about 400 million people or somewhere in 2050 in Africa. So this middle class focus more on maybe a processed good. Their consumption now is shifting to more processed good, which will attract foreign direct investment into Africa for market seeking. So foreign direct investment, we have different type of foreign direct investment. Foreign direct investment for resource seeking and foreign direct investment for market seeking. So we are expecting more foreign direct investment for market seeking in Africa because of the growing population and the growing middle class in Africa. Thank you, Pamela.
Thanks. And over to you, Amit. Thank you so much, Kwasi.
Thanks, Kwasi. Yes, thank you, Mavis, for that wonderful question. Look, you know, from my point of view, at least, the debt challenge exists. Debt servicing is often a reason that governments have gone to seek, to raise capital from the diaspora. What one needs to bear in mind often is that it's not your GDP that pays off your debt, it's your revenues that pays off your debt. So the way for the governments wanting to raise diaspora bonds would be to show that whatever project they are asking their expatriates for money is going to be used and has a revenue potential that is going to be able to pay back the promised coupon rate. And if they are able to present that credibly, ring fence the diaspora bonds, the special vehicle that doesn't allow any government to change that arbitrarily, I think that could help. I would say at this point in time may not be such a great idea. If you look at the interest rates on US dollars right now is quite high. So there would be just raising that and topping that would be extremely a risky proposition to go for. Some degree of fiscal stability should arrive before even a talk, even a diaspora bond can be considered. Look, I mentioned earlier that what needs to be remembered is that couple of things before putting up a bond in the market. Your target investors must know that what they're investing is going to be invested in for the purpose it's been raised for, right? So that needs to be done. Attractive rate of return. It has to be good. It has to be better than what they might be getting in their OECD countries where they're living. Governments could look at making it tax-free to make it attractive, if nothing else. You need to know how to navigate a foreign regulatory agency where that bond is going to be issued. So if you remember, Ethiopia was forced to pay $6.5 million just because it failed to register with the US Securities and Exchange Commission. before it issued the Renaissance bond. So picking that right jurisdiction is also important. Disclosure rules often in some financial centers are perceived to be more stringent than others. Then, of course, it's a question of publicity. What sort of promotional campaign is going to be carried out before those bonds are issued? And that means investing in marketing campaign, doing overseas roadshows, slick PR campaigns. These all make a difference. And bond applications process are often complex. So you need to convey how to tap into those diaspora bonds. So all those factors need to be, these are practical factors that need to be considered before even talking about issuing diaspora bonds. Thank you so much.
Great. Thank you so much to both Amit and Kwasi. Mavis, Elizabeth, thank you for your questions. I'm not seeing any hands or if anybody else would like to make an intervention. We are just around, gone over 20 minutes for this, but I think it was very, very stimulating. Amit, thank you for spending time. I know you're going on to 7 p.m. now, and we appreciate you spending time for that. I want to just use this opportunity at this time again to thank you, Amit, to thank you, Kwasi, for a wonderful presentation. It has certainly brought us to stimulate our thinking in this direction of the financial system and how it supports economic growth, being the lifeblood for a country's economy. So thank you for that. I want to use this opportunity as well to thank the teams of ISS, of AUDA-NEPAD, for their grateful support, especially members of the ISS Partnership Forum, the Hans Sneijden Foundation, the European Union, the Open Source Foundations, the governments of Denmark, Ireland, Netherlands, Norway, and Sweden. We really appreciate this. This brings us to the final conclusion of our Erudite series on African futures. And as I have said in all the series that we have had, this will be culminated in our Inception Think Tank Conference to be held on the 3rd and 4th and 5th in Addis Ababa of October. So we look forward to your continued participation and staying tuned with us. We want to thank especially the participants who have joined us today. Thank you very much, and thank you for completing the poll that was on your screens. So with that, I'd like to wish you all a wonderful weekend. Thank you again for joining the space, and please follow us as we continue the discussions in Addis Ababa in October. Thank you.